Let's do a quick market review, and long story short, if you're not long, you should be, because this market is looking pretty strong and the buy climax is in full effect. And you guys remember what our current thesis is, right? The buy climax. So we're going to see stocks shoot up pretty rapidly, then we're going to see that 10 to 20% correction, and then we're going to see multiple months of sideways movement before the general bull market continues, because this bull market is not over. So you always got to think in time frame. Short term higher, medium term we're going to get that 20% correction and that sideways movement, and then long term the resumption of the bull trend. But now let's jump into the data from Macro Ops to see how the thesis holds up. And you know Macro Ops is our global macro research and consulting firm. So looking at the small caps, in the other video we mentioned that the McClellan summation index was close to triggering a buy signal, which it actually did. The Russell 2000 is probing the upper range of its year-to-date sideways range, which you know we've talked about. It's been going sideways for a long time. And net speculative positioning is its most short since early 2019, and that's a positive sign, because if a bunch of people are short, everybody knows what happens when the stock actually goes up, or in this case the index. All those shorts got to cover and you get a bunch of buying pressure. So as this is probing the upper range of its consolidation right now, we might see that breakout. Right here is a chart. The red line is the semiconductors and the black line is the Russell. What we might be seeing is the semis actually signaling the way forward for the Russell. And you know we use semiconductors as a signal for the general market, the risk appetite. When these are doing well, the rest of the market is usually doing well too. But currently we still favor the NASDAQ over small caps, and they should continue to lead. Last week we saw breadth strongly reverse from oversold levels. And remember, we've been having a weird relationship with breadth over the last few months, because breadth was looking bad but the market kept going up. And what we finally realized, which is rare, this doesn't usually happen, but breadth actually had to catch up with where the market was going. And now that seems to be happening. You can see small cap breadth in these charts is catching up to the stronger breadth in the NASDAQ. See these strong reversals, breadth in all these different charts, the orange line, popping higher. And this is positive. You want all the stocks moving together. And it gives us a signal that the buy climax that we're talking about should have some more legs. Moving over to Japanese markets, if you're truly global macro, there is a changing of the prime ministers, because the current prime minister is saying that he's not going to run again, which means a new guy is coming in, which the market actually likes. You can see from the breakout right here, a strong bullish thrust out of a 7-month bull flag. And they like it because it means it's a continuation of Abe's stimulus and the great fiscal spending in the near term, which is always good for markets. It's liquidity, right? More money in the economy means asset prices are going to move higher. So as we can see, the Nikkei broke out of its 7-month bull flag. Now it's overextended in the short term, but we'd be interested in initiating long positions on a pullback near the 21-day moving average. So definitely a market to keep your eye on. Currently, the US 10-year bonds, they're trading in a sideways consolidation. And a number of factors are helping keep the bid under bonds, even as the market keeps going up, because you would think it would fall, right? The price of bonds, because these are a safe asset that people pile into when things get rough. But the things keeping them up are relative value, the COVID Delta concerns, and a global safe asset shortage. So there's still a buying opportunity here. We're buyers in the green zone. So when it kind of moves to the bottom of this consolidation period. The recent jump in yields, meaning that bond prices like this went down and the yield went up, actually disagrees with what our indicator is telling us. And ours is this red line right here. They're kind of diverging, meaning that we think yields will fall back lower to where we're predicting them. Now, when we talk about relative value, which you know we mentioned up here, right? Relative value is one of the things that are propping bond prices. Well, relative value is how much yield is the US giving versus other countries, because people can put their money anywhere, right? And I say people, but really it's institutions. So if you look at the US versus Europe, there's a wide yield spread, meaning that the US treasuries are way more attractive to European investors because they could actually get a yield here. And if they're going to be moving their money from overseas, then what's going to happen to this? Price of the bonds is going to go up, yields are going to fall. And why do they do this? Well, there's a concept in markets, right? And in life, money is going to go to where it's treated the best. So money is going to be always chasing that yield. So that's why something we look at in all markets, not just bonds, is relative value. Now, as we talked about before, we are moving away from the peak global liquidity that we used to have. And now we're kind of transitioning into a slowdown from the recovery we were previously in, meaning that a lot of the forecasts for what's going to happen with yields are way too optimistic. Here's another interesting chart with the Delta variant. You can see down here, this is India's Delta variant, which struck up much earlier than every other country. And you can see the huge spike here and then how it petered out pretty fast. So hopefully we're thinking that India will also serve as a guide for how quickly the Delta variant burns itself out in these other countries, including US, which is facing it right now. That would be very good for markets. And if you're looking for a stock to get into right now, Netflix is breaking out of its 14-month sideways trading range. As Alex says here, there must be a lot of people tuning into season 2 of their Netflix original Too Hot to Handle. And all that tells me is that Alex is definitely watching season 2. But as you can see here, it's breaking out from that tight 14-month sideways trading range, and the next measure measured move target is 675. So it's a time to get in if you're looking at Netflix. One space we're really bullish on is cannabis. And if you look at this chart, you can see the valuations versus other industries. We still have a long way to go. So we're very bullish on the industry long term, but we obviously have zero clue where it trades over the short term. Green Thumb Industries is one of our favorite plays on this theme. And our lead equity analyst, Brandon, he actually had the CEO of the company on a Twitter space. We'll be releasing that recording pretty soon. And if you're not following Brandon on Twitter, you should. He's at MarketPlunger1. Posts a bunch of great stuff and has a lot of big names on his Twitter spaces. And as I'm scrolling here, Michael K. Williams, he's passed away. I'm sure you heard about that. Very sad. And as I mentioned before in previous videos, if you haven't seen The Wire, you need to. It's the best, most impactful TV show ever made. And he played a very, very big role in it. You'll see why. And you know I talk about The Wire a lot because I'm a big TV guy. I really appreciate the good stuff. And really the only type of media that has absolutely blown my mind and just opened me up to a whole different world. And as an investor, it's important to be open-minded. And this is one of the few things that will really just blow the doors open for you. And it's not about investing, obviously, but just in life, it's a good thing. So watch The Wire. And if you need help getting exposure to this market, make sure you check out our system. We're doing very well right now as the market continues to climb higher. And it's really easy for us. It only takes like half an hour a month to even execute this system. So it's great. And you get awesome returns too. If you want to learn how to use it yourself, then just check out our free training. I'll put a link to it in this video and down below in the description and comments. It's a great time to start using it if you're not already, because this bull run is going to continue, especially during this buy climax. So click right here to check out that training and I'll see you inside.